profitability score and why it's important for you to understand what it is and how to leverage it to build a better business, put more profit in your pocket, get to higher valuations, better terms on investment, and larger exit multiples. First and foremost, well, over at Bootstrapper Capital, we're focused on providing the most affordable and flexible capital of choice for profit-led small business owners. And when we're doing this, we actually came up with the concept of a profitability score to help us solve the problem that we're focused on. In order to provide this affordable and flexible capital, we need to first understand, well, why is capital so expensive in the first place when it comes to our market? Small businesses, right? In the small business market, there's a lot of perceived risk, right? Like any market, markets get made, supply and demand. And when you're an investor potentially investing your capital into small businesses, you're trying to offset the risk associated with the reward, which is the returns. So in order to reduce the cost, what you have to really do is reduce the risk. Right. So our goal over at Bootstrapper Capital is to figure out ways that we can help business owners reduce risk inside of your business so that the byproduct becomes cheaper, more affordable capital that we can deploy, that we can then raise and deploy into your business. Right. So we're trying to help you decrease risk. And then we're also trying to, in the back end, decrease the cost of us, running our own business as capital allocators, which hopefully at the end of the day gives us our focus. Which by focusing on these things, we could decrease the cost of capital by helping businesses become less risky. And then ultimately by simplifying and creating innovation around how we find deals, diligence deals, service deals, right? All the components that go into the back end, operational expenses of our business. If we could reduce those and reduce the risk, then that's savings. And then that savings get passed on to you guys as business owners that we invest in, right? So in order to achieve this goal, because that's the why, we came up with this thing called the Profitability Score. And the Profitability Score is a very simple benchmark that we're able to use to help you decrease the risk of your business, specifically over time, because things take time, right? Good things take time and everything starts somewhere. When we look at the Profitability Score, what we're really breaking down is two different components. Instead of just like business alone and your business risk or your credit risk, right? We've broken it down into pragmatically the two components that actually drive sustainability towards profitability inside of a company for the long term, which is the business itself and then also the people, right? So we're really looking at the business risk, which is heavily tied to the operational risk of the business, right? So the ability to support throughput and continue to run in an efficient and effective manner. The secondary component is the people component. Are the right people in the right roles doing the right things? And do we enjoy doing it? Are we going to be able to do it for a long period of time? Is the happiness score high? So we focus on two things, the risk ratio and the happiness score of the people inside. The two of those things combined equate to your profitability score. So we've quite literally taken it from an art to a science so that we can mathematically figure out the risk, both qualitative and quantitative inside of your business. In terms of the benefits, right? Why should I care about a profitability score? And why should I want a higher profitability score? Reality is it's pragmatic, right? We made it up for ourselves so that we could better support businesses building, profit-led companies to put more profit in your pocket inside of our ecosystem. And then we could deploy capital. I already covered that. But reality, us aside, even if we weren't in the equation, you should still care about your profitability score because just fundamentally, it's really important. Break it down to the core components. If you build a higher profitability score, inherently means there's less risk. Lower risk ultimately means higher valuations for your business. It means when you go to raise capital, there's going to be better terms on that capital, terms on investment. If you go to sell your business, right, there's 5 exits of ownership. You're eventually going to master all 5. The 5th and final is the sale. You're going to get a larger exit multiple when it comes time to sell, right? Why? Because your business is a more transferable asset. Buyers want to buy assets that they can easily take over and run, right, profitably. So you want a transferable asset. One of the core focuses that we focus on in terms of improving the profitability score is the operational equity or the risk ratio inside your business. Higher risk ratio, better operational equity, more transferable your asset is. Ultimately, all of it combined ties to sustainability. And sustainability is really just how long are you going to be putting profit in your pocket for? And we're thinking about time value money when we're thinking about valuing things and what is something worth. Something that's going to put profit in my pocket for 100 years is way more valuable than something that's going to put profit in my pocket for 1 year, right? I want sustainable long-term assets that are putting profit in the pocket. These are the benefits. This is what you unlock when you start to care about and focus on your profitability score. And it all starts with understanding what it is, right? Really, what we're trying to do is unlock value, and we're trying to build wedge equity. So right here, we have this little screen that's like, hey, Chris, welcome back. You have $730,000 of wedge equity built, and you can tap into a $130,000 equity line of credit, right? Well, what does that mean? That's what we're trying to achieve. That's what we're trying to accomplish. We're trying to build equity so that we can unlock capital, because trapped inside of all of our businesses right now is trapped capital that's ready to be unlocked. And that's called building wedge equity, right? The way in which we build wedge equity is by getting exit ready so that we're always exiting, so that we're building a better business over time, right? And then systematically, we're reducing risk inside of our business, which increases the value. Let's take a second. Let's take a breather. Let's take a pause. And let's talk about why, right? Let's talk about the market dynamics in terms of risk, reward, and how we can actually build wedge inside of our business, or the incremental value, how we can grow the incremental value of our business over time by focusing on these things. So on this top right graph, we have a risk and we have a return, right? And then on the curve, that's our business's performance, right? So over here, bottom right, we have high risk. And if we follow it over to return, it's low return for investors. What we're trying to do fundamentally in our businesses is always decrease the risk or perceive risks, ideally realize risk, right? If we can decrease the risk, shift that risk to the left, now you take that dotted line and you follow it up on the curve, and you got a higher return. If you lower the risk, you're going to increase the perceived or realized return for investors. By understanding the market dynamics, you can flip the script and you can actually leverage these dynamics to be in your favor. That's what we're trying to do here. That's why we created the profitability score. It's a simple way to benchmark so that you can then leverage the market dynamics in your favor to build a better business. On this bottom right-hand chart here, we have time in business and we have the value of the business, right? If we do nothing, that's the red line. So no matter what, time is always moving forward, right? It's one thing that we can't make more of, right? It's something that we can't control, is time. It's always going to progress forward. And if we don't do anything that changes our business fundamentally, if we don't reduce risk in our business, if we don't unlock value in our business, if we don't take set actions that accomplish the concept of building wedge equity, then the value of our business is going to stagnate. It's going to stay relatively the same. However, if we understand what we can do inside of our business to actually unlock value, and we take those actions, that's the green line up here, then systematically over time, our business becomes more valuable. And this thing in the middle, this yellow, that's right here on the bottom right, as well as on the top chart, right? Through risk reduction, we're doing this thing called building wedge. And the wedge is the incremental value. It's the profit in your pocket. It's what you're doing for your business that's going to be a net benefit for you, right? When it comes time to, higher valuations, better terms on investment, larger exit multiples. When it comes time to put more profit in your pocket to potentially raise capital from investors or sell it because it's a more transferable asset. So by focusing on reducing the risk in your business, we can intrinsically increase the likelihood of a good return for anybody who's deploying capital. And you always got to think of yourself as an entrepreneur. You are your own first investor, no matter what, right? If you don't have an external investor today, you minimally have an internal one, and that's you, right? So you got to think about this for yourself, right? And then you got to think about it for other folks, the other side of the table. If you can decrease the risk, then you can naturally intrinsically increase the likelihood of a better return, which will ultimately increase the value of your business over time, right? Now, when we look at this stuff, we've gone a step further and we've tried to break it down even further in terms of, okay, on this graph, this all sounds good, but what are specifically these said things that allow you to traverse this green line? Like, what actions are you actually taking to focus and build the wedge, right? So that's what we've tried to put an effort, energy, and focus into to keep it simple, make it simple, and hopefully allow you to make some simple bets in your business to build wedge equity. And we've simplified it around this equation that we call the wedge equity formula. Wedge equity in our mind is brand equity multiplied times the operational equity, and that's going to be your wedge equity. So brand equity, what is it? Brand equity is your money's multiple. So when you're going to value a business, traditional common sense or common knowledge, it's not common sense, common knowledge, is you're going to take a multiplying effect of, some people revenue, EBITDA. Traditionally, it's SDE, seller's discretionary earnings, right? The profit in the pocket of the future buyer. And you're going to multiply that times a money's multiple. That's like a market average, right? So you're going to look at other similar businesses within similar revenue ranges. What multiples are they trading at? Where does the market get made? Take that multiplier effect, multiply that times RSD. That's going to give us our valuation. That's traditional common knowledge. However, the reality is in real life, you have this other whole component, which is the risk ratio. The risk ratio is the risk that intrinsically lives inside the transferability of your asset, of your business as an asset. And if your business has a high, is risky, then that's going to be a discount rate that gets applied to the money's multiple. So the goal here is to increase the money's multiple, right, by building brand equity, while also simultaneously decreasing the risk, building operational equity. Those two things combined becomes the ability to build wedge, right? And that's what we focus on. And then just like eating a cake, right? How do you accomplish something that's such a big task? You do it one bite at a time. So to take it a step further, that's why we've created this concept of the 5 exits of ownership. And we tried to simplify the components of building a better business at each of the various stages or life cycles of a business. And we believe that there's 5 of them, right? An exit 1 business is much different in terms of complexity than an exit 4 business. So strategy equals focus. And what we've tried to do is create bite-sized, focused checklists in terms of how to build operational equity and take risk off the table at each of these various life cycle stages. That's what we want to be able to accomplish. And if you were to join the community over at Bootstrapper Capital, the Bootstrapper community, and you were to take the Profit-Led Pledge, make the pledge to be profit-led, right? Then you would be able to work through this process of becoming a profit-led certified business. And once you take the pledge, then you'll be able to unlock value. And when you're unlocking value, you'll be able to get access to this template. And you'll actually work through the process of going through a full valuation. I mean, it's simplified, right? But you'll work through the process of understanding the valuation of your business today. So we'll work through the seller's discretionary earnings. We'll work through what the baseline multiplier, and we have some smart logic in the back because we track this stuff every day, but we'll do it quickly for you, simply. And then you'll be able to assess your brand equity and your operational equity, and that's going to get you that risk ratio. So we've created a really simple, do it yourself, do it with you, because you could also do it live in the community, way for you to understand your existing business valuation and the amount of risk inside of your business today. And then we created this really cool calculator, kind of step-by-step template, in a sense, a journey, if you may, of your happiness score. And again, when we get back into the profitability score, it was broken down into 2 components. It was your business risk, which is your risk ratio, byproduct of your business valuation, and your personal risk, which is your happiness score. And we've actually taken happiness down to a science, a math, and we've created this equation. And it's a 2-part process. First part is to understand where you are today, where you aspire to be in the future, and what you want to achieve within the next year, within the next 12 months. What's your next exit? So we can get specific and set goal lines, because strategy equals focus. Step number 2 is really the equation. And the way that we've broken down personal happiness, which is crazy that we've been able to figure out happiness as an equation, it makes a ton of sense. Let me walk you through it. We take happiness score as taking your tank fillers, which are things in your business that you enjoy doing. We then take into account the things in your business that you don't enjoy doing. And based off of the valuation process, we've already assessed where there's gaps in your business. So if you have a gap that is something you like doing versus something you don't do, that's a point, right? So we've simplified the way to increase your points based off of tank fillers and tank emptiers, based off your business today. Because if you have a profitable business, if it's a good business, but you don't enjoy running it, it's probably not going to be sustainable, right? So this matters. It truly does matter. It's the qualitative and the quantitative component of risk in a business, right? So you have your tank fillers, your tank emptiers. Then you have your financial satisfaction score, which is really an income gap analysis of, what's your aspirational income? Where's your income at today? And then we're putting a risk ratio to that, right, in terms of a deviation. And then the final component is the time balance score. So we're taking the concept of your fillers and your emptiers, your financial satisfaction, and your time balance, right? Because typically what happens is if somebody is able to do the things they enjoy and they're able to achieve the financial goals that they want and they're able to do it in less time, they tend to want to do that for a very long period of time. That's usually a very sustainable situation. So we're trying to understand the sustainability factor and function of your business from a people component. We're going to start with yourself, and then you're going to ultimately trickle this down to other people inside of your business, especially key leaders. And you're going to take the happiness and the profitability, and you're going to be able to combine the two of them together to get to your profitability score. And that's going to actually show you realistically how much risk lives inside of your business today. If you want to work through this process, you can do so over in the community, right? Take advantage of it, work through the 1, 2, 3. Everything that we have that's broken out is very actionable, and it's going to take you through the whole process. Ultimately, you can activate your full account and you can get access to all of the benefits, that are associated with becoming a profit-led, business. And, if you are watching this to the end, we appreciate it. As always, trust the process. Where's that? Trust the process, commit to the journey, right? We want to get to a stable income. We want to have more time. We want to have a happier overall life. We want to build a better business. We want to put profit in our pocket. And hopefully in the process, we'll be able to decrease the risk in our business so that, we become hopefully a more fundable asset. Perhaps we become your capital partner of choice over at Bootstrapper Capital. We could build better together. Until next time, trust the process, commit to the journey.